Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is October 17, 2022, and I'm back in the office and I'm ready to go over your three threes for the week. I'm going to go over the top three market movers and the economic data from last week and this week, our favorite three asset classes, and how we are positioned on the short term for our equities and on the bonds. So let's jump on in.
Okay, let's go over the top three market movers for October 17, 2022. Number one, we have a big week of corporate earnings. Number two, we have housing data for September. And number three, let's go over the chart of the week, which is FHFA price change. All right, but let's first go over a little bit of the economic data from last week. It was a very turbulent week. We had a lot of losses, not only on the bond side, but also on the equity side. And a lot of that had to do with the consumer price index for September. It was estimated to come in at 0.2, but it actually came in at 0.4. The core was estimated to come in at 0.4, and it came in at 0.6 month over month. Now, this actually kept the annual at 8.2, so that there hasn't been a move there, but the core CPI actually went up. So this drove the market down pre-market, and it actually kept driving the market down even more once the market opened on Thursday. But then we had the CPI reversal. And a lot of that had to do with the algorithms started to click off, and there was a lot of trading. Some technical indicators were hit. There was a huge reversal for the day. We actually saw a 194 point swing on the S&P 500, about over 5% swing. And it was the fifth largest intraday reversal in the history of the S&P 500, which was pretty amazing. And it was also the fourth largest for the NASDAQ. So extremely volatile day. Led into Friday. We actually gave about half of it back on Friday. So we're seeing a lot of volatility in this market, and we're probably going to continue to see it throughout the end of this year. All right, let's go over the major asset classes on a weekly basis and on a year-to-date basis. Well, this is like a broken record. The only positive, again, was the US dollar up 0.46. The bonds were down about 1%. The equities were down about 1.5 to 3 to 4. We had real estate, gold, and commodities down 2 and 3. But on a year-to-date basis, we still have the US dollar and commodities both being the winners. Also, they're both our two largest asset classes, have been all year, which has helped us navigate this market. So a lot of negatives on the equity side across the board, and Bitcoin being the biggest loser, down 57% year to date. All right, let's look at what we have going this week, and what's going to be the big movers for this one will be corporate earnings. This is one of the busiest weeks for corporate earnings. I listed a lot of them here throughout the week. I didn't list all of them. It is too long, but here are some of the major ones on Monday, Tuesday through Friday. And so you can get a good feel for what we're planning to see this week. All right, number two big mover for the week will be the housing data. On Tuesday, we have NAHB housing market index for October. On Wednesday, we have not only housing starts, but building permits for September. And Thursday, which will probably be the biggest mover for the week for housing data, will be the existing home sales for September. Right now, the estimate is at 4.7, which is lower than last month's 4.8 million home sales. So we shall see what that brings. But look at what's happening to the housing market. From May to October, 5 months worth of data, we've had some major declines in some of the big markets out there. Oakland, San Jose, and Austin have all dropped over 14%, with Austin being the one closest to us, just 3 hours down the road here from Dallas. So we're going to focus a little bit on what we're seeing here in Austin. Well, this graph here is from Zillow, and they actually take a look, and they're estimating the home buyer demand moving forward for homes. And right now they're seeing a 52% decline in demand for home purchases. So those that are in the real estate market there in Austin area, it's going to be tough throughout the remaining of the year. This leads us into the chart of the week, which is the FHFA, which is the Federal Housing Finance Agency price change on a month over month. Now, it took 18 months for home prices to go from up 10 to minus 10 in the lead up to the great financial crisis or the housing collapse of 2007 and 8. Well, if we fast forward, it is taking just 3 months to go from 19% positive to -7 this time around. We've seen a drastic move from those highs to a negative. So by the Fed raising interest rates and the home prices starting to come down, is this time different? That's the big question. Are we going through a COVID situation where it's just a one time and we'll bounce back? Or are there more troubles ahead in the housing market? We shall see. We're going to keep a close eye on this. All right, well, let's go over the top 3 asset classes on a long-term basis. We've had a change. Utilities has dropped out of the top 3 and it inserted into the top 3 is commodities. So we have T-bills, US dollars, commodities, all still very defensive and the primary drivers of this market. All right, let's go over bonds on a short-term basis. Again, we go over this every single week, and we're having the 10-year interest rates went from 1.5 and they just as of Friday broke 4%. This is the second time they've gone up. This is the first time it's closed above 4%. But as you can see, the aggregate bond index is down almost 16% year to date. Since we last went to protect mode on August 29th, the bonds have dropped from 101 down to 94. They dropped another 6%. That is a huge drop in the bond market. And this leads us to our next chart. This is the US 10-year Treasury bond index. This is the total return that you get if you were to buy this 10-year Treasury bond from 1928 to 2022. Now, right now we're sitting year to date as of 10/14 down 18% on this 10-year Treasury bond. We're on pace for the worst year in history. That is a very long time. The last time that we've had a significant drop was in 2009. That was down 11%, but that was coming off 2 very large years, 2007 and 8, for bonds. This is the worst year that we're probably going to see in bonds on the US side. On the global side, 322 years worth of history. This is the 4th worst year. This is after 1721, 1865, and 1920. So a major, major decline in the bond market. A lot of firms aren't very familiar with that. Matter of fact, on a relative basis, this is probably our best year on the bonds because we have been on the other side. We've actually been short a lot of bonds throughout this year. All right, well, let's go over the equities now. On the equity basis, we've been in and out of bond or equities quite a bit this year. The last one we went to protect mode in August 30th. And since that time, the equities have sold off even more. They've dropped down 11% just since we got back out on the equity side. And the year-to-date drawdown is almost 25% for equities. Again, we are in protect mode, have been in protect mode for quite a while on the bonds and the equities. That's where you should be or should have been if you were listening to these webinars. All right. That's it for this week. Thank you for joining us. Our next update is Monday, August 24th. And as always, continue to like, comment, and subscribe to our channel. We're giving this information out to you, and I believe it's very timely. As you can see, the markets have dropped quite a bit since we told you to go back to protect mode. So that's it for this week. We'll see you next week. Thank you.